This talk was basically inspired by my going to a number of investment conferences where the typical message that I heard was, the old rules don't work anymore. Now, particularly after the great crisis, we have to throw out all the old textbooks. We got to learn new things, and there are simply new ways that we have to behave. Well, the first lesson that people like to talk about is buy and hold is dead. What you need to do is to time the market. We know perfectly well you can't simply buy and hold. That's a recipe for disaster. Well, let me tell you what the problem with this new idea is. The first one is that nobody, and I mean literally nobody, knows how to time the market. I am very fond of my friend Jack Bogle's remark, which was, in 40 years in the investment business, I've not only never known anyone who knew how to consistently time the market, but I've never known anyone who knows anyone who could consistently time the market. So the fact that you can't do it is only part of the problem. The main part of the problem is that if you do try to do it, behavioral considerations get the best of you, and it's not that you simply can't do it and you make random mistakes, it's that you always tend to do the wrong thing. And here's a chart that shows the stock market, the ups and downs, the solid line, showing you the ups and downs of the Morgan Stanley Capital Index, All-Country World Index. And the ones that are shaded, I think some of you have the things in front of you. The shading doesn't look quite as strong as it should, but it shows the flows of money into equity mutual funds. And one of the things that you notice is that when the stock market is high, that's when money goes into the market. And when the stock market is down, that's when the money comes out. You look at the recent debacle in the market, and you find that there was more money taken out of the stock market then, right at the bottom in 2008, than ever before. And the money, of course, the most of the time when the money came in was in the end of 1999 and the beginning of 2000, which many of you will remember as the peak of the dot-com bubble. And this doesn't include 2011, but let me tell you that right now, when people are scared to death that the world is coming to an end again, the money is pouring out of the stock market. But it's even worse than that. Well, I've got to put this one in first. In order to do this properly, first of all, you got to know when to get in and when to get out. And if you happen to just miss the best 30 days in the market, even though over the long pull, the last 15 years haven't been great, but they were 6.7% rate of return, if you had missed the best 10 days, that basically the return was close to zero, and if you'd missed the best 30 days, you lost about 4% a year. But as I said, it's even worse than that you can't time. You typically do the wrong thing. Again, this may be a little hard to see, but the blue lines are the amount of money that are going into growth funds. And these lines are the amount of money going into value funds. So during the last quarter of 1999, when money was flowing into the stock market, and the first quarter of 2000, the money all went into the growth funds. In fact, we at Vanguard, who do index funds and actively managed funds. Most of our actively managed funds were value funds, and we were finding that money was pouring out of our value funds. And what you do in a mutual fund complex is, typically what happens is you simply exchange the fund for the money fund. And then you have to look at where the checks were written from the money fund in order to find out where the money was going. And we looked at the checks, and they were all going to this little company in Denver called Janus. And it was going into the Janus 20 fund, which had Janus's 20 best ideas. They were all internet companies. And we had this sick joke: why go through all of these transactions? Let's just bundle up the money and send it to Denver so that we don't have to go through all the transactions. So the timing is so bad that the ins and outs are wrong, but the things that people do, the kinds of funds, value funds, were actually cheap then. They put it into the wrong funds. There was a study done that actually looked at the difference between the average stock return and the average investor return. When you look at a figure that says the market did 8% over the last 20 years, that assumes that you bought at the beginning and held through the end. But investors put money in at different times. If you weight it not by you put all the money in at the beginning and you see where it was at the end, if instead you say, what did the investor earn, realizing that the investor was buying at the top and selling at the bottom, you find that in this study, the investor was getting only 4.5%. In other words, this timing actually hurt investors to the extent of 700 plus basis points. My own work suggests this might be a bit of an exaggeration, but every time people do these kinds of studies, you find that this timing does not help you. It makes your return even worse. Well, if you can't time, what can you do? Well, one thing that you can do, and this is very controversial, a lot of academics think that this is the wrong kind of strategy. You can do something called dollar cost averaging. And what that simply means is you put the same amount of money into the stock market period after period. You throw up your hands. I don't know how to time, but as you would do with a 401k plan, you set it up and you put money in every quarter or every month, no matter what is happening. And the advantage of that, I mean, you know, it's not necessarily optimal all the time. If the stock market has a long-term uptrend, you're better off putting your money in at the very beginning. But for most people, that's the way that they have the money to invest anyway. And the advantage of this is that you tend to buy more shares when the price is down, and therefore that tends to reduce your average cost. So here's a couple of examples of a 5-year period, and we have a very volatile market that ends up flat in the first set of columns. The market goes down from 100 to 75, it then goes down to 55, it then doubles to 110, and then ends up at 100. So you end up exactly where you started, a flat, terrible market. A little bit like the market that we had in the first 10 years of the 2000s. The next set is a great market. The market starts at 100, it goes to 110, 120, 130, 140. And you put the same amount of money, $1,000 in each time. Where do you end up with most money? Well, most people would say we end up with most money in that wonderful market that went up. But in fact, because you have more shares, even though you ended up at 100, you have $6,060 in the case of the flat market, and you have only $5,900 in the case where the market went consistently up. And so even in a terrible period, such as the first decade of the 2000s, Dollar cost averaging was a very effective strategy. I like to quote Warren Buffett, who in one of his essays used the following quiz. Suppose you like to eat hamburgers, but you're not a hamburger manufacturer. Or suppose you're buying automobiles and you're not an automobile manufacturer. If you're going to be buying hamburgers, do you want the price to go up or go down? If you're going to be buying automobiles in the future, do you want the price to be higher or lower? And, he says, this is a kind of obvious question. And he says, okay, now, here's the final exam. If you expect to be a saver over the next period, do you want prices to go up or to go down? And he says, you don't want them to go up if you're going to be putting money in. It's like buying hamburgers or cars at higher prices. It's only people who are about to retire that want to see the market go up so that they can get up at higher prices. So it's a nice, cute thing from Mr. Buffett. What else can you do? Well, again, you can't time, but what else can you do? You can rebalance. Now, rebalancing simply means that if, let's say, you wanted to be a 60-40 investor, 60% in stocks, 40% in bonds, what you do is every year, once a year, I'm assuming, in January, once a year, you look at your portfolio, and if it's away from those percentages, you bring it back to those percentages. So you rebalance to 60-40 every January. And look what happens during this period of buying actual index funds, a Russell 3000 fund, which is often called a total stock market fund, and a Lehman aggregate. It's actually the Barclays aggregate now. I don't know why they changed the name. Well, at any rate, it used to be the Lehman aggregate bond index. And what you notice is that the not rebalanced portfolio gave you 10.7%, and the rebalanced portfolio gave you 12.2%. Now, what's the alchemy that does this? How do you get a higher rate of return by just doing this rebalancing? Well, just think what was happening. We're rebalancing every January. So it's January 2000. Stock market was at the roof. The Federal Reserve was increasing interest rates, so bond prices were down. You look at your portfolio, it wasn't 60-40, it was closer to 80-20. You had 80% in stocks and 20% in bonds, so you take a little money off the table and put it into bonds. You didn't know it was the top of the market. Nobody knew it was the top of the market. But you knew you were unbalanced, and you take some money off the equity table. It's now January of 2003. You don't know that the bottom of the market was in October of 2002. But what you do know is that the Federal Reserve had reduced interest rates, your bond prices were way up, your equities were way down, and so you had about 55% in bonds and 45% in stocks, so you sold some stocks and bought bonds. And that's why this alchemy works, that in any case where you have these very volatile markets, and if we are in a continuation of a tough period of very volatile markets, rebalancing is always going to reduce your risk in terms of the volatility of your return, and in markets that are very volatile, it will tend to increase your average return as well. Okay, another lesson that I hear all the time is what we've learned from the financial crisis is diversification doesn't work anymore. It's clear that diversification doesn't work anymore. Look, we've just had markets going down. The U.S. market's down. Europe is down. Latin America is down. China is down. All the markets go down. Diversification, what happens, in fact, the correlations of markets go to 1, particularly when they're going down. Diversification fails you just when you need it most. We don't want to diversify anymore, and that's the end of the story. Well, let's take the argument as it is. Are all the markets so correlated? Let's take a couple of markets. These are rolling correlations. Let's take the correlation between the bond market and the stock market. Well, the correlation of the bond market and the stock market has become negative. I mean, this is a great diversifier. Bonds have become an even better diversifier. So it's not the case that all markets have moved up and down together. Bonds have been a great diversifier. Gold has been a great diversifier. Gold is basically protects you from Armageddon, and if in fact the world, if Greece completely defaults at the end of the week, and there's a run on Italian bonds and Spanish bonds and so forth, gold will probably be over $2,000 an ounce. I'm not telling you to go out and buy gold, but the point is diversification is not dead. There are assets that help you diversify. And even when the correlations are very, very high, that doesn't mean that you shouldn't diversify, because let's look at the correlations between emerging markets and developed markets. Now you can see that they tend to be very correlated. That is to say, when the developed markets go up, emerging markets go up. When developed markets crash, emerging markets crash. Again, during this terrible lost decade where developed markets gave you a 0 rate of return, even though the correlations were very high, you would have been very happy to have some emerging markets in your portfolio because they gave you a 10% annual rate of return. So even though the correlations were high, this doesn't mean that you shouldn't diversify. So again, that new lesson that we are supposed to learn, I think, does not hold water. Now let's put these things together. We know that this was, the first decade of the 2000s was the lost decade for investors. People got disgusted with the stock market. You didn't make any money in the stock market. But what if you did, and I'm taking these percentages from my random walk book because I've got percentages that I recommend for a 50-year-old investor. And the percentages that have been in random walk for the last 10 years have been a third bonds, a third U.S. stocks, 17% in emerging markets, foreign, and 17% in developed foreign markets. I'm not saying this is necessarily the greatest allocation, but that's the one that I had been recommending. So let's take the one that I suggested people use in the old lessons of random walk. And we'll do two things. We'll do that versus just holding undiversified 100% U.S. stocks. So you start with $10,000 in the U.S. stock market. We know it was a terrible decade. You didn't make any money. You ended up about the same place where you were at the beginning. But what if you diversified that way and you rebalanced every January? That's the calculation. You rebalance every January, you had that diversified portfolio, and what you notice is you almost doubled your money during that decade, despite the fact that that was one of the worst decades for investors, probably one of the worst that you've been through. You have to start to think about, going back to the 30s to think that you had worse investments than that. So I would say that diversification does work, and so does rebalancing. The next message that I hear when I go to conferences is, you don't want to buy index funds anymore. These are tough markets. We have to go active. And what I would suggest to you is the one thing, I think all of us who talk about investing and give investment advice have to be very modest about what we know and don't know. But I will tell you the one investment maxim that I am absolutely sure about. It's one of the few things I'm 100% sure about. And it is, the lower the fee that I pay to the purveyor of the investment product, the more there will be for me. That's the only thing I'm absolutely sure of. So I've been trying for a long time to look statistically, how do I find the best active managers? Are they the ones that performed best last year, the last 2 years, the last 5 years? Is it entirely a style thing? And the one thing I can come up with statistically that works is the funds that have the lowest turnover, do less buying and selling, and have the lowest explicit management fees do the best. And this divides it into quartiles. Again, the period 95 through 2010. The funds, and these are active funds now, that have the lowest quartile of expenses have the highest returns. So the one thing that if you disagree with me about index funds, you want to go into active funds, you want to pick the best ones, the best way that you can do it is pick the ones that have the lowest turnover and the lowest explicit management fees. And of course, the quintessential low-cost funds are index funds that simply buy and hold a large portfolio of stocks. And the kind of index fund that I recommend are the broadest index funds possible that hold the entire market. Now, I had, in the Random Walk book, argued for index funds because I had believed in what is called the efficient market hypothesis. In other words, I believe there are a lot of smart people out there and information gets reflected pretty quickly into market prices. If there's a biotech company in South San Francisco that develops a cure for cancer, the FDA approves it, it looks like it's going to be a blockbuster drug, and the stock ought to be worth double what it was before the FDA approval, it'll double right away. It's not going to double slowly over time because people will realize that any purchase they make before it doubles will guarantee them profit. But even if you disagreed with me, and there are certainly a lot of people who disagree with me that markets are really pretty darned efficient, even if you disagreed with me, indexing has to be an optimal strategy. Because when you think about it, let's think about all the stocks in the United States market. All the stocks have to be held by somebody. So that if there is some investment manager that is holding only the stocks that did better than the market, there's got to be some other investment manager who is holding the stocks that did worse than the market. We don't live in Lake Wobegon. We cannot all be above average. So if 8% is the market performance over a period, there'll be a distribution. There'll be some that do better, there'll be some that do worse. But now let's say that the average active fund charges 1 percentage point in fees. What that's going to do is shift the entire distribution to the left. There will still be some who do better than the market, but on average, the active funds are going to give you 7%, and the amount of funds that beat the market are going to be much less than half. And if you could buy an index fund at essentially zero cost, because now competition has driven index fund costs down to 6-7 basis points, either through regular index funds or ETFs. If you can get the market return at zero or close to zero cost, you will then you're guaranteed to outperform the average active manager. Now the data are, I've done this every time I do a new edition of my Random Walk book, I ask, okay, did it work? Every time I do it, something like 2/3 of active managers are beaten by the index. Here's a bunch of different benchmarks: small cap, large cap, multi-cap, global, international, emerging market, whatever it is. Every 5-year period I do this, 2/3 of the active managers are beaten by the index. And the third that win in one period are not necessarily the same third that win in the next period. There's very little persistence. This is, I think, a very telling chart. What I've done here is I've taken every single mutual fund that existed in 1970. And there were 358 of them. Now there are more mutual funds than there are stocks. There are thousands of mutual funds. But here there are only 358. So what I did is I looked at how those 358 did. But wait a minute, there's a problem. The problem is that a lot of them didn't survive. There were only 108 that survived, and all I can do is look at how the survivors did. So these data have what's called survivorship bias in them. Now you can be sure that the ones that didn't survive had even worse records than this, because there's a nasty little secret in the mutual fund business. You know, you run a complex of many different funds, and one of them has a lousy record. So what you do is you kill it by merging the fund into a fund with a better record. So these have to be the better performing funds. But again, now you see there are a few that did very well over the whole period. But you can count on the fingers of one hand the number that did 2% better than the market or more. And when you go active, you're much more likely to be on that bottom part of the distribution than on the top part of the distribution. Again, fixed income, it's even worse. More and more of the fixed income funds are outperformed by a simple index fund. You know, I know out here I would always get the argument, look, Bill Gross can outperform with his PIMCO funds all the time. Well, he had a pretty good record, except that last year, when the 10-year Treasury was at 3.7%, he said we are in a bond bubble, and he shorted treasuries. The 10-year Treasury yields 2.9% now. So, you know, even Bill Gross has...
1.9, isn't it?
Oh, 1 point. What did I say?
2.8. You said
No, it's 1.8. Yeah, to 1.8. Thank you, John. So, again, bond market, exactly the same thing. In Europe, here's a 10-year period. Again, a lot of survivorship bias in it. Most of the distribution is in the negative side. And even in emerging markets, often people will tell me, look, Bert, emerging markets are very, very, very inefficient. You want to be an active manager for emerging markets. Well, in part, precisely because of the inefficiency of emerging markets, you want to index. Emerging markets have very big bid-ask spreads. It's very costly to transact. There are stamp taxes. In emerging markets, you can almost find nobody who has beaten a broad-based emerging market index. Now, this is something I took right from the Wall Street Journal, because I'd always get the argument, look, I'll show you 7 funds that outperformed for the last 10 years. So the Wall Street Journal took a number of funds in the 2000s that had outperformed every year. They found 14 funds that had outperformed the S&P 500 for 9 consecutive years. And then they said, they did it, this isn't even mine, okay, we'll take it forward 1 more year, how many outperformed? And there was just 1. And that shows you the problem of the lack of persistence. Now look, I'm actually a very moderate guy. I don't tell you to index everything. I don't index everything myself. I don't think there's anybody who has studied the stock market and been in the stock market all of his life who doesn't have a gambling instinct of some sort. But look, there's enough evidence in favor of indexing that at least the broad core of your portfolio should be indexed. You want to have a little fun around the edges, fine. You can then do it with much less risk if the broad core of your portfolio is indexed. Now let me just conclude with just a couple of things about my present hobby, about diversification, because I think that we do need to diversify and diversify broadly. And what we know about investors is that investors tend to have what's called a home country bias. You put more of your money in your home country than you necessarily should. For example, in France, we sometimes looked, not recently, but a little before this, looked at equity portfolios in France, which is 3% of the world's GDP, and 97% of their portfolio is in French securities. We tend to put too much in our home country. Emerging markets are growing much faster than developed markets, and if you think of the problems that we've got now with debt to GDP ratios of 140% in a place like Greece, which is falling apart, over 100% in Europe, around 100% in the US, Japan at 250%. One of the things about emerging markets, China, for example, their debt to GDP ratio is 17%. And it's true of a lot of the emerging market countries now. China's growth has been unprecedented. It's now the second largest economy. The currency is severely undervalued. And because of the peculiar nature of China, where a big part of the local market, the so-called A-share market, is not included in the capitalization that's in index funds, and because government-owned shares are not part of it, China has only 2%. If you were a world indexer, you get only 2% in China, whereas China is at least 10% of the world's GDP. The thing people don't quite realize, China in the early 1800s was about a third of the world's GDP. It was a huge, huge country. They were then beaten in 2 opium wars by the British and devastated. Mao called the 1800s the century of humiliation. Then they were invaded by Japan. They had a terrible civil war. And Mao's 5-year plan, first one seemed to work, but the state-owned enterprises were woefully inefficient. The collective farms couldn't even grow enough to feed the people on the farm. And then this remarkable man, Deng Xiaoping, came to power and was everything that Mao wasn't. Mao was an ideologue. Deng Xiaoping was an intensely practical man. He would say, I don't care if the cat is black or white, just that it catches mice. To be rich is glorious, he said. Imagine this coming right after Mao. And you started this unprecedented growth rate. There is no time in history, no country in history that has grown anything like what China has done. I think it will continue because China is a country that's developed in the East where Beijing and Shanghai are, but very undeveloped in the center and West. And part of government policy is, because there's a lot of unrest in the center and West, is to bring that growth to the center and West and let people enjoy some of the riches that have been created in the East. You have, and in a university we know this, students come from China, they're very well educated, they're extremely hard working. This is something I learned from one of my mentors, Sir W. Arthur Lewis, who was a Nobel laureate who really developed the field of economic development. And I remember him telling me, you know what's really important for economic development? You give me a population that reveres education, as the Chinese have since the time of Confucius. You give me a population that's hardworking. You give me a people with an entrepreneurial spirit. You give me people with a gambling spirit. And the genius of Deng Xiaoping was to unleash that. And I think that there is far more that is going to happen. So I would say finally on diversification, I'm a big believer in a world index fund, and I buy for myself and my grandchildren a world index fund, but you only get 2% China there, and I don't think you want to be underweighted in the fastest growing major economy in the world. So I think I stopped almost on time, and hopefully we have a chance for questions.